Hello friends, today's topic is tea, coffee and rubber development account section 33AB. In this topic we will be studying amount of deduction available to an entity which is engaged in either tea or coffee or rubber industry and how the deduction is available, what is the quantum of the deduction available, what are the conditions to be satisfied by the entity in order to claim the deduction under section 33AB, we will be studying in this topic. In this topic, we will be studying the deduction available to an entity which is engaged in tea or coffee or rubber industry, wherein an amount is deposited in a special deposit account and the entity will be eligible to the amount of deduction based on the deposit amount or 40% of the profits of the entity, whichever is lower. However, in order to claim a deduction, in order to be eligible for a deduction, the industry, the entity have to utilize the funds deposited in the special account for the specified purposes, and the accounts of the accounts maintained by the entity should be audited by a chartered accountant, and the assets purchased should not be sold for a specified period of time, and the utilization of the funds for a specified purpose should be within a prescribed time limit. So there are several conditions which are to be satisfied by the entity in order to be eligible for a deduction. So let's go subsection wise. Here I have mentioned the bare act of section 33AB. We will read it and I will provide you additional notes wherein what are the points or what are the provisions or what are the additional points which you should be keeping in mind while interpreting the provisions. Now on your screen, tea or coffee or rubber development account, eligibility and quantum of deduction is the subsection 1, where an SSC carrying on business of growing and manufacturing tea or coffee or rubber in India has, before the expiry of 6 months from the end of the previous year, has, before the expiry of 6 months from the end of the previous year, meaning if it is financial year 1920, then the option should be exercised before 6 months from the end of the previous year, meaning September 2020, or before the due date of furnishing of return of his income, whichever is earlier. So the option is to be exercised, or the amount, meaning the amount will have to be deposited in a special account, in a deposit account, before 6 months from the end of the previous year, or filing of return of income, whichever is earlier. Point A, deposited with a national bank. National bank is with NABARD. National bank is nothing but national bank with NABARD, which is National Agricultural and Rural Development Board. So an account is to be opened with NABARD, wherein amount is deposited therein. Deposited with the national bank any amount or amounts in an account hereinafter in this section referred to as special account, maintained by the SSC with that bank in accordance with and for the purposes specified therein, a scheme, and for the purposes specified in a scheme hereinafter in this section referred to as scheme, approved in this behalf by the tea board, coffee board, or the rubber board. So the amount should be deposited in a national bank with the national bank, and it should be as per the purposes specified by a scheme approved by tea board, rubber board, or coffee board. So your amount is to be deposited with National Bank, and account in this regard is called as special account. Second, amount could either be, can also be deposited any amount in an account hereinafter in this section referred to as deposit account, opened by the SSC in accordance with and for the purposes specified in a scheme framed by the tea board or coffee board or rubber board as the case may be, hereinafter in this section referred to as deposit scheme, with the previous approval of the central government. So amount is to be deposited in a deposit account. Clause A was special account with NABARD, and here a deposit account as per deposit scheme which is approved by central government. So amount can be deposited either in National Bank or either in special account, and secondly amount can also be deposited, can either be deposited with a in a deposit account as per deposit scheme which is approved by central government. If amount is deposited in such account, then you will be eligible for a deduction subject to other conditions being satisfied. The SSC shall, subject to the provisions of this section, be allowed a deduction, such deduction being allowed before the loss, if any, brought forward from earlier years is set off under section 72. Fine. So the deduction is allowed before setting off any brought forward loss. The amount of deduction available is a sum equal to the amount or the aggregate of the amounts so deposited, or a sum equal to 40% of the profit of such business, 40% of the profits computed under the head profit and gains of business or profession before making any deduction under this section. So before making any deduction under section 33AB, whatever is the profit, on that profit 40% will be applied, or the amount deposited in aggregate during the previous year, whichever is less between the two is the amount of deduction which is available to the SSC under section 33AB. And profit as per clause B should be before deduction under section 33AB, and such deduction under section 33AB will be before adjusting brought forward loss under section 72. So friends, till now we have studied as per subsection 1, the deduction will be eligible if the amount deposited is before the expiry of 6 months of the previous year, or filing of India tax return whichever is earlier, and amount is deposited in a special account or deposit account, and the quantum of deduction is equal to amount deposited or 40% of the profit and gains, whichever is less will be the amount of deduction available under section 33AB. Now next portion is proviso, wherein no deduction to a partner of SSC firm or member of SSC AOP body of individuals. So in this case what is happening is deduction is already claimed by firm or AOP BOI. So where a deduction has already been claimed under section 33AB by firm or AOP BOI, then again the deduction won't be eligible to its members, to its partners. So as per this proviso, provided that where such SSC is a firm or any association of persons or body of individuals, the deduction under this section shall not be allowed deduction under this section shall not be allowed in the computation of the income of any partner, or as the case may be, any member of such firm, association of persons, or body of individuals, only because the deduction was already allowed to a firm or EOP BOI. Next proviso of subsection 1 of section 33AB, non-eligibility of deduction in any other previous year, meaning deduction which has been claimed under a particular or under the relevant previous year for the amount deposited, that particular deduction won't be eligible in any other previous year, meaning if it is allowed, then that will amount to double deduction. Accordingly, such deduction which is already allowed won't be allowed in any other previous year. Provided further that where any deduction in respect of any amount deposited in the special account or deposit account, as the case may be, has been allowed under this subsection in any previous year, no deduction shall be allowed in respect of such amount in any other previous year. So no deduction in respect of such amount on which already a deduction is allowed previously under this subsection, then the same amount won't be eligible for further deduction in any other previous year. Now subsection 2 is audit of books of accounts. So as we have discussed earlier, wherein in order to be eligible for deduction, there are further conditions, and one of the conditions being accounts maintained by the entity should be audited by a chartered accountant or by an accountant as per definition to section 288. It could be the audit of the accounts could be as per the income tax law, or it could be as per any other law. It could be as per any other law for the time being in force. And if the accounts are audited as per any other law, then the only thing will be income tax law is fine with that it accounts are audited by any other law. Apart from that, there will be a prescribed form which needs to be uploaded, which is form number 3AC. It will have to be uploaded along with the audited report. So subsection 2, the deduction under subsection 1 shall not be admissible unless the accounts of such business of the SSC for the previous year relevant to the assessment year for which the deduction is claimed have been audited. Shall not be admissible unless the accounts are audited by an accountant as defined in explanation below subsection 2 of section 288, basically a chartered accountant, and the SSC furnishes along with his return of income the report of such audit, meaning the audit report, the report of such audit in the prescribed form. Prescribed form in this case is form 3AC, duly signed and verified by such accountant. So SSC has to furnish along with his return of income the audit report in the prescribed form, which is duly verified, signed by the accountant as per section 288. Provided that in the case where the SSC is required by or under any other law to get his accounts audited, so any other law, it shall be a sufficient compliance with the provisions of this subsection. If such SSC gets the accounts of such business audited under such law and furnishes the report of the audit as required under such other law and a further report in the form number 3AC under this subsection. So if there is any other law, then audit report as per that law plus report in a prescribed form, which is form number 3AC under this subsection. So basically accounts of the person should be audited, and the audit report along with the return of income should be furnished by the SSC in order to be eligible for a deduction. Subsection 3. Condition to withdraw the amount from the special account or deposit account. So friends, an amount can be withdrawn from the special account or deposit account only for specified purposes. As we have discussed earlier, that the amount withdrawn should be utilized for the purpose specified as per scheme of the respective board, and any amount utilized other than the specified services, other than the specified activities, then such amount will be straightforward taxable in the hands of the SSC. And apart from the specified activities, there are other purposes as well, wherein if amount is withdrawn for such other purposes, in case of such other circumstances, then nothing will be taxable in the hands of the SSC, wherein there is closure of business or partition of HUF, liquidation of company or dissolution of firm. In these specific circumstances, amount withdrawn won't be taxable in the hands of the SSC. Subsection 3. Any amount standing to the credit of the SSC in the special account or the deposit account shall not be allowed to be withdrawn except for the purposes specified in the scheme, except for the purposes specified in the scheme or in the circumstances specified below. First is closure of business. If the amount is withdrawn, then it won't be taxable in the hands of the SSC. Death of the SSC in case of proprietary business, in case of death of the SSC, then amount withdrawn won't be taxable in the hands of the SSC. Partition of HUF, dissolution of the firm, liquidation of a company. In these specific circumstances, amount withdrawn by the SSC won't be taxable in the hands of the SSC. Subsection 4. Amount withdrawn and utilized for the purchase of specified assets would be chargeable to tax as business income. So friends, here you can see amount is withdrawn and utilized if for certain specified assets, then the same will tantamount to that it is not as per the scheme, and accordingly it will be taxable as business profits in the hands of the SSC. So specified assets are if a machinery, if a new plant or machinery is installed in office premises or residential accommodation, then it will be termed that it is not as per the scheme. If the amount, if the asset purchased is any office appliances, then the same won't be eligible for, then the same won't be counted as a specified asset for the purpose of scheme, and accordingly no deduction is available. Any machinery or plant, the whole of cost which has been allowed as a deduction previously, then that asset or that particular asset again a deduction is not allowed. And any new plant or machinery if used for any product, any article or thing which is mentioned in 11th schedule, which is a non-priority sector schedule. So meaning if any amount withdrawn is used for asset on which deduction cannot be claimed, then SSC won't be eligible for any deduction under section 33AB. Subsection 4. Notwithstanding anything contained in subsection 3, so it starts with non-obstant clause, meaning it will supersede the provisions of subsection 3. Subsection 3, we have studied that amount can be withdrawn for the purpose of specified business, for the purpose of specified activities, or it can also be withdrawn for the purpose of specified circumstances. So, subsection 4 will supersede subsection 3, where any amount standing to the credit of the SSC in the special account or the deposit account is released during any previous year by the National Bank or withdrawn by the SSC from the deposit account, and such amount is utilized for the purchase of any machinery or plant to be installed in any office premises or residential accommodation, including any accommodation in the nature of guest house. So, similar provision as to additional depreciation. Any office appliances not being computers, here any office premises or residential accommodation. Third point, any machinery or plant the whole of the cost of which is allowed as deduction, whether by way of depreciation or otherwise, in computing the income under PGBP of any previous year. So if any deduction was previously allowed on this particular machinery or plant, then again a deduction cannot be claimed under section 33AB. Point D. Any new machinery or plant to be installed in an industrial undertaking for the purpose of business of construction, manufacture, or production of any article or thing specified in the list of 11th schedule. So any article or thing which is specified in the 11th schedule, or you can say a non-priority sector schedule, in those cases deduction or the purchase cost of such machinery won't be allowed as deduction under section 33AB. And subsection 4, as stated in the first line, subsection 4 will supersede subsection 3, wherein, for example, even if there is closure of the business of the SSC and such business has purchased, for any reason, such business has purchased any of this specified asset as per subsection 4, then also the deduction under section 33AB won't be available to the SSC. So friends, this was subsection 4. Now, just this part of subsection 4, accordingly the whole of such amount which has been deposited in a specified asset mentioned in subsection 4, so utilized, shall be deemed to be the profit and gains of business of that previous year and shall accordingly be chargeable to income tax in that particular previous year. Now, subsection 5, amount withdrawn on the closure of business or dissolution of a firm. So, if any amount is withdrawn when there is closure of business as per clause A of subsection 3 and dissolution of firm, which is as per clause D of subsection 3, these two subsection, if there is any withdrawal of amount, then it will be assumed that if there is end for this purpose of business, if there is any income which is chargeable to tax in the hands of such business, for the purpose of taxability, it will be assumed that the business is still continued. Meaning, even if the business is closed and if there is any income remaining which is chargeable to tax under profit and gains, such income will be taxable in the hands of such businesses, assuming that the business is still continued for the purpose of taxability. Subsection 5, where any amount standing to the credit of the SSC in the special account or deposit account is withdrawn, the amount is withdrawn during any previous year by the SSC in the circumstance specified in clause A and clause D of subsection 3. So the SSC which is specified in clause A and clause D of subsection 3, the whole of such amount shall be deemed to be profit and gains of business or profession of that previous year and shall accordingly be chargeable to tax as income tax as the income of that previous year as if the business had not closed, or as the case may be, the firm had not been dissolved. Any amount withdrawn on the closure of business as per clause A or dissolution of a firm as per clause D will continued to be taxable in the hands of the SSC, assuming that the business is not yet closed. So, as per subsection 5, read with subsection 3 the exceptions. This 5 exceptions, you can say subsection 5 is an exception to the exception wherein clause A and clause D both will be subject to tax. So as per subsection 3, for the specified circumstances if amount is withdrawn, then nothing is taxable as per subsection 3. However, as per subsection 5, for closure of business and dissolution of firm, if there is any amount withdrawn, it will be taxable as profit and gains. So, for closure of business and dissolution of firm, amount will continue to be taxable in their hands in case of by reading the provisions of subsection 3 reading with subsection 5. Subsection 5 states that for closure of business or dissolution of firm, any amount withdrawn will be taxable in the hands of the entity. Now, friends, subsection 6, utilization from the scheme for business purpose not available as a deduction, meaning if a deduction is allowed under section 33AB, no further deduction will be allowed under section 37(1). So once a deduction is allowed under section 33AB, no further deduction will be allowed under any provisions of profit and gains, just to avoid double deduction. Subsection 6, where any amount standing to the credit of the SSC in the special account or in the deposit account is utilized by the SSC for the purposes of any expenditure in connection with such business, meaning it has been utilized for specified purposes which is eligible for deduction under section 33AB in connection with such business in accordance with the scheme or the deposit scheme, such expenditure shall not be allowed in computing the income chargeable under the head profit and gains of business or profession, meaning such expenditure which has already been allowed under section 33AB won't again be allowed in computing income under chapter profit and gains from business or profession. Subsection 7, consequences of non-utilization of withdrawn amount. If the amount is not utilized, the amount withdrawn is not utilized for the specified scheme. In this case, the amount which has been withdrawn, if it is unutilized till the end of the previous year, then that entire amount which is non-utilized will be subject to tax in that previous year itself. Subsection 7, where any amount standing to the credit of the SSC in the special account or deposit account which is released during any previous year by the National Bank or is withdrawn by the SSC from the deposit account for being utilized by the SSC for the purpose of such business in accordance with the scheme or the deposit scheme is not utilized either wholly or partly. The amount withdrawn is not utilized either wholly or partly within that previous year. The whole of such amount, or as the case may be, part thereof which is not utilized, shall be deemed to be profit and gains of business and accordingly chargeable to income tax as the income of that previous year. So the unutilized amount will be deemed to be the profit and gains of business and accordingly subject to tax. Proviso, provided that this subsection shall not apply in a case where such amount is released during any previous year at the closure of the account in circumstances B, C and E. B, C and E is other than closure of business or firm dissolution. The remaining clauses, if it is utilized for these clauses for B, C and E, then nothing will be taxable under subsection 7. So subsection 7, such amount which is not utilized from the withdrawn account will not be taxable in the cases of business of B, C and E, which is nothing but debt of the SSC partition of HUF and liquidation of company, in these cases, nothing will be taxable. The unutilized amount, the non-utilized amount won't be subject to tax. So clauses B, C, and E of subsection 3. Consequences of sale or transfer. What if the specified assets, a certain asset which has been purchased, are sold subsequently? What are the consequences? You have withdrawn the amount from the special account and you have also utilized the amount for purchasing capital asset, and accordingly you have claimed deduction under section 33AB, and after claiming deduction you have sold that asset. If you have sold such asset within a period of 8 years from the date of purchase, then such a transfer which is within the 8 years can be and will be taxable as profit and gains in the hands of the SSC. So as per subsection 8, if within 8 years an asset is transferred for which a deduction under section 33AB was previously claimed, so much amount of the deduction which has been claimed under section 33AB will be taxable as business income in the previous year in which the asset is sold. And there are two exceptions to it. Where an asset is transferred to government authorities, then nothing will be reversed, the deduction won't be reversed as per subsection 8, and a firm transfers its asset to a company as a predecessor and successor in the plan of succession. If an asset is transferred by a firm to a company, in those circumstances as well, nothing will be reversed. The deduction claim under section 33AB will continue to apply. Subsection 8. Where any asset acquired in accordance with the scheme or the deposit scheme is sold or otherwise transferred in any previous year by the SSC to any person at any time before the expiry of 8 years. So before the expiry of 8 years from the end of the previous year in which the asset was acquired, again before the expiry of 8 years from the end of the previous year in which the asset was acquired. So if the asset was acquired on April 2010, so from the end of the previous year, from March 2011, from March 2011, the number of years of 8 years will start. The first year will be previous year 11-12. April 11 to March 12 will be the first year, and from that 8 years will be started counted. So before the expiry of 8 years from the end of the previous year in which the asset was acquired, such part of the cost of such asset as is relatable to a deduction allowed under subsection 1 of section 33AB shall be deemed to be the profit and gains of business or profession of the previous year in which such asset is sold. In the previous year in which such asset is sold or otherwise transferred, and shall accordingly be chargeable to income tax as the income of that previous year. So in the previous year in which the asset is sold or transferred will be the year in which the income will be deemed to be profit and gains. The deduction claimed earlier under section 33AB will be deemed to be profit and gains and accordingly subject to tax, provided that nothing under this subsection shall apply. That the asset is sold or otherwise transferred by the SSC to the government, a local authority, a corporation established under central, state or provincial act, or a government company as defined under Companies Act 1956. So any asset transferred to government authorities, nothing will be taxable. Second proviso, where the sale or transfer of the asset is made in connection with succession of a firm by a company. In the case of succession of a firm by a company, either of the business or profession carried on by the firm as a result of which the firm sells or otherwise transfers to the company any asset, and the scheme or deposit scheme continues to apply to the company in the manner applicable to the firm. So it will be assumed that the firm still holds the asset where there is a succession plan. It will be assumed that the firm still holds the asset even if the asset are transferred to the company in the succession plan. Now the explanation to just mentioned above, explanation to the succession plan. The provisions of the clause 2, which is related to the succession plan mentioned above from firm to company of the proviso shall apply only where all the properties of the firm relating to the business or profession immediately before the succession becomes the properties of the company. So all the properties of the firm should become property of the company. All the liabilities of the firm relating to the business or profession immediately before the succession becomes the liability of the company. So all the properties of the firm, all the liabilities of the firm should become part of the company, and all the shareholders of the company who were the partners of the firm immediately before the succession. So all the partners of the firm will become all the shareholders of the company. These conditions should be satisfied by the firm which is going into succession plan. If these conditions are satisfied, then the firm will be eligible. Then it will be assumed that there is no indeed a transfer between firm to company. If any of these conditions are not satisfied, wherein all the properties of the firm are not transferred, or either all the properties of the firm are not transferred, or all the partners of the firm are not becoming shareholders of the company, then in that case, the asset which is transferred by the firm to the company will not be eligible for any exemption, and accordingly the deduction claimed earlier by such firm will be taxable as profit and gains. So this was clause 8, which stated the consequences on sale or transfer. Then power to central government to, in cases where this subsection won't apply, central government has power to notify anytime that this section provisions of section 33AB won't be applicable with effect from so and so date. So as per subsection 9 of section 33AB, central government is empowered. Central government, if it considers necessary or expedient so to do, may by notification in the official gazette direct that the deduction allowable under this section shall not be allowed after such date as may be specified therein. So the provisions of section 33AB may be unnotified, may not be applicable from so and so date if central government by notification specifies. So subsection 9 only empowers central government to specify such notification. Explanation in this section. Coffee board means the coffee board constituted under section of the Coffee Act 1942. National Bank means the National Bank for Agriculture and Rural Development established under section 3 of National Bank for Agriculture and Rural Development, which is nothing but NABARD, part of the special account. Rubber board means the rubber board constituted under subsection 1 of section Rubber Act 1947, and tea board means the tea board established under section 4 of the Tea Act 1953. So friends, this concludes the part of section 33AB of tea or coffee or rubber entity which is eligible for a deduction where an amount is deposited in a deposit scheme. So just to sum it up, subsection 1 stated eligibility and quantum of deduction, wherein the amount is supposed to be deposited before expiry of 6 months from the end of the previous year or filing of return of income, whichever is earlier. An amount is to be deposited in a special account with NABARD or deposit account as per scheme approved by the central government. The quantum of deduction is the sum equal to the amount deposited or 40% of the profit and gains, whichever is less. And next proviso is a deduction available to firm won't be available to a partner again, because that would amount to double deduction. And any deduction claim in this previous year, the same deduction won't be available in other subsection in other previous year. And subsection 2 says the audit of the books of accounts of the SSC is mandatory. and it is required to be submitted. The audit report is required to be submitted along with the return of income of the SSC in order to be eligible for claiming the deduction. Subsection 3 stated there are 5 circumstances under which the deduction under section 33AB will be continued to be eligible. However, clause A, closure of business, and clause D, dissolution of firm, when you read it with subsection 5, the deduction under section 33AB won't be eligible to closure of business and dissolution of firm. Subsection 4, amount withdrawn and utilized for purchase of specified assets if certain assets, if used as office appliances, if installed in office premises or residential accommodation, if any machinery on which deduction has been previously claimed under any previous year, and if any new machinery is installed for used for manufacturing any article specified in 11th schedule. So if amount is utilized for specified assets, then deduction under section 33AB is not available. Subsection 5 we already discussed. Subsection 6, utilization from scheme for business purposes not available as a deduction. This is already been discussed, wherein if deduction is claimed under other sections of the act, it won't be eligible. If deduction is claimed under section 33AB, the same deduction won't be eligible under other provisions of profit and gains. And if the amount is not utilized, if it is withdrawn, the same will be taxable in the same previous year. And if the asset purchased under the scheme of section 33AB is transferred within 8 years, then the same will be subject to tax. Then the deduction claim earlier will be subject to tax as profit and gains under business or profession, exceptions being if asset is transferred to Government of India or asset is transferred from as a succession plan by a firm to a company. Thank you.